Hi, this is James Jeng, and today we're going to be going through how to analyze a multifamily deal. A lot of times people will ask me, what is this deal worth? And so I put together a case study of around, inputs, outputs, returns, and then how to do some scenario analysis. So let's go over to just sort of do a high level of the model. I put it into four different boxes, really are your inputs. So box one is really just sort of your basic information about the property, what you think the property is worth, just sort of at a high level, or maybe what the listing broker told you the price would be. And then, your debt terms, your residual cap rate, your sponsor comp. And then box two really gets into your unit mix. So this will come off the rent roll offer memorandum. And then box three will be your expenses and how you're underwriting year one. And then box four is really your projections. So going forward, what's your 1 through 6 projections, and that's going to feed. So the first four boxes are really your inputs. Box 5 through 10 are your outputs. So based on the information you put in the four boxes, what is your cash flow of the property? What's it going to sell for? What's your passive cash flow to your limited partners? How much do you make as a sponsor? And then getting into the loan data, and then sources and uses as you put the deal together. So let's just jump in here to this deal. So I used the 200 unit deal, pretty standard deal, Class B multi 1980s product here in Dallas. 70% ones, 30% two beds. One in place rent's about 1,000, and then we think we can take the market rent to about 1075. It's 95% occupied today. Individual HVAC, pitch roof, just sort of your standard property. So how much is this property worth? That's what we're going to dive into today and see how the different parts of the underwriting can affect the valuation. So at the front end, I just sort of plugged in a number, which I thought was a reasonable number, was 21.5, which is about 107 a door right now. Rehab, I used about 4,000 a door. It's about 800,000. And then for loan amount, I used 75%, which is pretty standard, but obviously request a loan term sheet. Based on the debt service coverage, this will be your actual loan amount. Interest rate's about 3.5 right now. Years of interest only, I kept that 1, which is pretty conservative. And then amortization, if it's a bank loan, it's 20 to 25 years. Fannie and Freddie, you're going to be at 30 years. Closing costs, this is going to be loan origination, third-party fees, attorney fees, title costs, acquisition fee potentially. So this is 2 to 3% depending on the size. Working capital, this is for you to complete your rehab and then request this back from the lender, or even have some money on hand to hold for downturns and reserves. Next is the residual cap rate or reversion cap rate. So this is what you think you're going to sell the deal for in year 5. Typically, this is your in-place cap rate today, or what your cap rate in the market is today, plus 10 basis points per year. So add about 50 basis points if you're going to sell the deal in year 5. Some people also look at a median cap rate for the class and the market. Next is the cost of sales. So this is when you go to sell the property, what's your listing broker fee going to cost? What's the title cost? This is typically 1 to 2% depending on the size. Next is sponsor compensation. So how much equity are you going to be receiving from putting this deal together? And that's going to come in terms of cash flow and sales proceeds. And then the last thing is asset management fees. So you are going to manage the manager. So typically this is 1 to 2% on top of the property management fee. Next is the unit mix. So this is box 2 on the model. This is really coming straight from the rent roll offer memorandum. You're going to plug in number of units, square footage, current rent, and then pro forma rent. So what you think you can charge for the units going forward based on the upgrade plan. So if you come in, do the rehab for 800,000 in the first year, how much can you get the rent to? Next is, we talked about the income. Now it's really about the expenses, right? So management fee is going to be anywhere from 3 to 4%. Usually for 200 units or more, it's 3%, 3 to 4% for 100 to 200 units, and then 4 to 5 for anything under 100 units even. But as you get closer down to 50, it's probably 5% or so. G&A, so this is going to be admin, advertising, professional fees, about 400 to 500 a door. Payroll is usually about 11 to 1,200 a door. But as you get smaller in size, this will increase per unit. Utilities, definitely look at the T12 historical utility bills. R&M is about 600 to 700 a door. Insurance right now in Texas is about 450 a door. if you have no major claims or you aren't in a floodplain. If you are, it's going to be significantly higher. Real estate taxes, take the assessed value times the current tax rate. That's the minimum. And then if your purchase price, like on this one, estimating about 21 million. If your assessed value is 10 million, then you need to bring that up to the current purchase price, about 90% of purchase price times the tax rate. And replacement reserves, this is going to be the lender is going to do an engineering report and basically look at the next 12 years and see what is the minimum that you need to do to keep this property in good shape, and then divide that by 12, divided by number of units. So usually it's around 300 a door per year in reserve. So you add all that up, and that is your total expenses. So we talked about sort of pro forma year one income from the rent roll, year one expenses. Now we're going to get into projections. Really, economic vacancy is going to be the first thing you project. And this is going to include your physical vacancy, which is, for vacant units that are completely, nobody's even living there, right? But then there's also vacancy from concessions, delinquencies, bad debt, employee units, model units, all those things that you don't actually collect. So I like to start, max, I would say, our minimum is probably 10 to 15% for B and C properties. So I start at 15%, make my way down to 10%, seeing as the physical occupancy right now is about 95%. Rent growth I kept at about 2%, based off of after adjusting for pro forma. And then other income, this is, other items like rubs or carports, reserve parking, late fees, all those types of things. Expense growth is about 2% to 3%, depending on if you think there's going to be a big real estate tax increase or insurance increase, then I would increase that more. And then other income, this is going to be all the other things: application fee, laundry income, late fees, utility bill back, month-to-month fees. All those things you're going to have to plug in right there as well, to really start. And usually you're looking at T12 and then any potential new income that you are going to start charging at the property. And so let's go back to the model here. So once you plug in, your basics on the property, the unit mix, the expenses, and then your projections in box 4, that's going to feed into your total returns right here. So here we'll go through sort of the passive investor returns, and then also what the sponsor is going to make and some of the outputs. So let's jump back. So in the summary, 5-year total returns about 70%. So that means if you put in 100,000 as a passive, you're going to receive 70,000 over the 5 years. Internal rate of return is just your return on a annual basis, based on when you receive those cash flows. And then the 5-year cash on cash is based on the passive cash flow, based on the property's cash flow, not based on the residual sale. And then the sponsor comp, that is how much you make in terms of equity override, asset management fee, and cash flow at the end when you sell the deal. So let's jump into the outputs, right? So this is, we'll talk about, based on all the inputs, this is what your property cash flow is going to look like. Gross potential, this is the top line. That's going to be if all the units were leased at market rent, but obviously that's not going to be the case. There's always going to be turnover. There's always going to be concessions, delinquency. So that subtract out the economic vacancy, we burn that down to about 10% over the 5 years, and then we hit that net rental income, and then we add in other income to get to total income, and then we add total expenses there. So income minus expenses, you get to your net operating income, which you have to pay your debt service first. This is principal and interest, starting in year 2. And then you want your 2 things that you're really looking for in terms of ratio. Debt service coverage is your NOI divided by your debt service, needs to be 125 or higher. And then expense ratio. So expense ratios are typically A and B class properties are probably 45 to 50%. And then B and C, I would say is 50 to 55% on expense ratio. So just double check that when you go through your underwriting. And in net sales proceeds, this is the next box. What is your property going to sell for? So you're going to do all these improvements. You're buying the deal, putting in your rehab, running the deal for 5 years. What's it going to sell for? So this property is coming out about 25 million, 125 a door at the end of year 6. So that's your NOI year 6 divided by your residual cap. And then you subtract out your cost of sales, pay off your loan, and then this is your net proceeds. And so this is where it gets a little bit tricky, but essentially this is money that comes back to you as a sponsor. Some sponsors have it where they pay back all their limited partnership money, and then they split the proceeds or some sponsors will just split the proceeds based on their equity override. So just double check your operating agreement and see what it says there to make sure you do that calculation correctly. And here is the passive cash flows, right? So we talked about the property cash flows, then we talked about residual sale at the end. This is year by year, sort of how much cash flow you're getting. So you have the property cash flows, which is your NOI minus debt service, but then your asset management fee is taken out, your sponsorship cash flow, and then you hit your property cash flow, what you actually receive as a passive investor. So this is what is typically shown on the package, right? So they usually don't show all these line items, but get to the passive cash flow here. So you can see in year one, it's higher because of the interest only, and then it decreases in year two, but increases back over time. And then it calculates the IRR for your passives over the 5-year cash flow analysis. In terms of sponsor comp, we talked about asset management fee. So this is usually 1 to 2% over the property management fee. And then cash flow to the sponsor, this is based off of the equity override and then your sales proceeds at the end. And then your P&I payments there as you pay down the loan balance over time. And then this last output is really your sources and uses, right? So this is really just a basic, all right, so I'm buying the deal for 21.5, rehab of 800, closing costs of 430, working capital 215. So all in, my total uses, I need 22.9 at closing. So where's that going to come from? Some of it's going to come from the loan, 16.7 million, and then some of it's going to be from the equity side. So you need to raise 6.2 million on this deal to close on the property and have the working capital necessary to run this deal. So coming back to the returns, so this is all in, sort of what your returns would be for the passive and then also for the sponsor comp. So let's go back to the model, because I mean you can see, if your return on 21.5 is 66 or so, then if you come in and adjust this and you go to let's see, I think I had this at 1% cost of sale. So that gets back to your original base case. And then let's say you come in and you are able to get the deal for 500,000 less, right? So that drives your return from 70% total return to 80% total return. So you can mess with that. And then also, let's say you want to be a little bit conservative on your residual cap. You go to 625, but you buy it at 21 million, drops you down to 5% total return or 65% total return. So you can make changes to there. I've seen people set up scenario analysis, with cap rate, with price, with rehab, with let's see, your pro forma rents, if you think that can be higher, or adjustments to your expenses. So run different scenarios here on the Excel to build out your total returns of what you think you have a strong case for. And then my background is number one as a Texan, born and raised here in Houston, and then went to school in Austin, and lived in DFW since 2006. I've been an underwriter, a lender, originating over 800 million in multifamily loans, invested in close to 6,000 units over 21 properties in DFW, Austin, and San Antonio. And if you want to receive this underwriting model, definitely subscribe to the YouTube channel, like and share this video, and then join the email list. So go to txmultifamily.com, join the email list. I'll send you the model. And then if you want to set up some time to talk, whether buying, selling, refinancing your next multifamily deal, send me an email and we can set up some time to talk. But I think that's it. Thanks a lot, guys.